Welcome to The Explainer. Today we're putting on our hard hats, grabbing our magnifying glasses and acting as entirely skeptical equity research analysts. We're leaving the corporate fluff and those flashy media headlines right at the door. Why? Because we are conducting a rigorous, data-driven forensic audit of First Citizens Bank shares, digging deep into their Q2 2026 financials. We're going to rip into the footnotes, run the quantitative models, and find out what's actually happening beneath the surface here.
Before we get to the good stuff, please note our mandatory compliance baseline. Disclaimer, this is an educational case study and quantitative analysis for informational and entertainment purposes only. It does not constitute financial advice, investment recommendations, or an offer to buy or sell any securities. Past performance does not guarantee future results. Please consult a licensed financial advisor before making any investment decisions. All data is sourced from publicly available filings and is subject to fair use for commentary and criticism.
All right, let's get right into it. The current stock price for First Citizens Bank shares, ticker symbol FCNCA, is sitting at $2,183.54. I know, that's a heavy absolute share price, right? It's a big number that acts as our raw hook today. But remember, price is what you pay and value is what you get. So we're going to immediately throw FCNCA into what I call the ultimate valuation gauntlet to see what the math actually says about this price tag. So what's literally jumping off the page here is the sheer contrast. Over in Group A, our cash flow models are flashing massive numbers. I mean, they're pointing to an intrinsic value well over $2,400, and that maxes out around $2,700 when we factor in things like tax shields. But then you look at Group B. Traditional dividend models absolutely punish this stock, valuing it way down near $1,150 to $1,200. Why? Simply because of their tiny 0.38% dividend yield. The takeaway here? If you're hunting for yield, this breaks your traditional models. But if you value raw cash flow and shareholder value creation, like with our FCFE model, FCNCA looks incredibly cheap.
Okay, moving on to our comparables in Group C, the consensus here is remarkably tight. Whether we're looking at a forward PE of 11.5, sector peers, or EV to EBITDA, the market is pricing the core operations right around $2,300 to $2,500. But Group D, well, this is where we ground ourselves in reality. The Q2 filings show an exact book value of $17.67.79. And if we look at net asset value, which is just tangible book value minus liabilities, we get a hard floor of roughly $1,722. To put that into perspective, even in an absolute fire sale liquidation scenario which models out near $1,400, you still have a massive, tangible cushion of hard assets sitting right beneath you.
And you know, this perfectly illustrates why we run Group E advanced and options valuations. Look, financial statements tell you where a company has been, but real options valuation tells you where it can go. By applying Black-Scholes logic to treat growth projects as call options, specifically factoring in their prior Silicon Valley Bank technology integration, plus their pending Q3 acquisition of 138 BMO branches with $5.3 billion in deposits, the intrinsic value per share shoots up to a massive $2,850. That optionality, it's like a hidden engine, and it is entirely unpriced by the current market.
But hey, we don't just blindly trust valuation models around here, right? We have to rip open the footnotes and find what the mainstream media completely missed. Let's look at 7 media blackout red flags. Right off the bat, we see the allowance for loan losses actually dropped to $1.48 billion, despite overall loan growth. Reserve releases like this totally obscure true operating margins. Next up, non-interest-bearing deposits shrank by over $1.13 billion quarter over quarter. Deposit mix deterioration is a quiet, lagging indicator of funding stress. Add in a flat core net interest margin because headline NIM hides the exhaustion of those acquisition accounting benefits, and a $7 million debt extinguishment loss they conveniently excluded from adjusted earnings, and well, a concerning picture starts to emerge. Even their third-party processing fees jumped 52.5% as back-office tech integration costs just quietly bleed cash. The headlines might scream about EPS beats, but adjusted pre-provision net revenue, which is usually way too wonky for retail headlines, is actually declining, and total commercial loan growth is up only 1.6% as macro credit demand slows down.
Now we have to stay completely objective here, because the overlooked green flags are equally staggering. Most notably, they quietly executed massive share buybacks, repurchasing nearly 24% of their Class A common stock. That is $6.3 billion in share count, silently disappearing below intrinsic value, while TV pundits were entirely distracted by top-line revenue. On top of that, their deposit beta is decelerating, dropping from a 64% peak down to 49%. Liability sensitivity is a bit complex for a quick soundbite, but it means their funding costs are stabilizing. And their credit quality? It remains remarkably pristine, with the net charge-off ratio improving to a tiny 0.29%. I guess the absence of credit blow-ups just doesn't generate clicks, huh? Throw in hidden strengths like a surging commercial leasing division, which gets forgotten in bank valuations, a massive 255 basis point expansion in adjusted return on equity, and surging fee income diversification, and you've got some serious hidden margin defense. Oh, and let's not forget that pending BMO acquisition adding $5.3 billion in low-cost deposits next quarter. Future creative integrations like that are almost always buried deep in the forward guidance footnotes.
So, with all that conflicting data, how would the titans of finance view this stock? Let's run a legendary investor's reality check. Starting with Ben Graham, the father of value investing. We calculate a Graham number of $2,820. Compared to the current price, there's a massive margin of safety there. Now, while it fails the net current asset value test, which, let's be honest, is entirely typical for banks, the forward PE of 11.5 easily passes his under 15 rule. For Graham, that's a definitive buy. What about Peter Lynch? Well, the PEG ratio sits well below 1.0 thanks to a 23.3% jump in quarterly adjusted net income growth. So for Lynch, that's also a buy. And Warren Buffett? You know he looks for solid owner's earnings, a consistent adjusted return on equity above 12.5%, and a clear economic moat. They hit all three marks. For Buffett, it's a buy across the board.
That brings us to a really vital concept for this analysis, the economic moat. Just briefly defining this, an economic moat, a term popularized by Morningstar, comes from 5 sources of sustainable competitive advantage: intangible assets, switching costs, the network effect, cost advantage, and efficient scale. Ultimately, a bank absolutely needs a wide moat to protect its margins from competitors over the long haul. All right, bringing this all together, here is our final verdict and synthesis of the forensic audit. Based on the average of all 21 rigorous valuation models we just ran, First Citizens Bank shares is structurally undervalued. It yields an intrinsic value near $2,250 per share, providing a really solid margin of safety against the current market price of $2,183. Furthermore, the company possesses a robust and resilient economic moat. This is primarily derived from high switching costs, thanks to their super sticky commercial and SVB tech clients, and the efficient scale of their deep, nationwide branch network density. And here's the kicker. The data suggests this moat is actively expanding over the next 3 years as they finalize that highly accretive BMO branch integration. Ultimately, here is your nuanced takeaway. Yes, there are genuine headwinds here, with deposit mix shifts and a stubbornly flat core net interest margin. However, the sheer scale of their aggressive share reduction program, wiping out nearly 24% of their stock well below intrinsic value, acts as an absolute fundamental floor. It's setting up a really powerful engine for long-term compounded equity growth.
We've laid out the math, the models, and the footnotes for you today. The models are pointing one way, but hidden flags suggest a storm. Which side are you on? Do your own homework.